Marc Ostwald from ADM Investor Services International with some thoughts on a slightly better risk appetite tone, very modestly, and what's going on with the oil market. My first chart is really just to highlight that volatility, as measured by the VIX Volatility Index, has started to ebb. However, when one looks at it from a longer term perspective, it still remains well above all the spikes that we've had over recent years. Nevertheless, there is cause for a little bit of bargain hunting going on. The next chart that we've got for this week compares the S&P 500 dividend yield versus the US 10-year yield. As one can see, there's been a huge swing in favor of equities in terms of the dividend yields. The big caveat on this, obviously, is the fact that dividend yields are very much likely to drop as revenues and earnings are hit very badly by the current downturn. Therefore, the bargain hunting I can understand. On the other hand, we've still got a whole load of bad news. We're just about to come into the Q1 corporate earnings season, and therefore those dividends are all likely to be cut where they actually exist in any case. This week, we had a reminder of a lot of bad things, particularly the sky-high rise in US initial claims. But my next chart is actually the Dallas Fed Manufacturing Survey, basically as a proxy for the fact of those sectors which have been doubly hit by both the COVID-19 lockdown and, on the other hand, the oil price war. As one can see, it plummeted to minus 70. That's the worst reading, and even worse reading than at the height of the global financial crisis. The fourth chart for today compares the US high yield bond spread for all sectors versus their high yield energy one. As one can see, there has been some tightening of spreads, but when one looks at it from any historical perspective, particularly against the prior oil price crash between 2015 and 2016, eminently, this is pretty much small beer. I can understand people looking for the much more attractive yields and the higher risk premiums which are factored in. But there is still a lot of debate without any clarity about where we're going in terms of reaching a peak on the COVID spread, and any agreement being reached by the big oil producers on reining in production about when we will peak. My fifth chart is just sort of a corollary to that, to show that we did actually have a very big inflow into high yield bond funds this week. In fact, a record level of around 7 billion. Nevertheless, that follows weeks and weeks of outflows, and perhaps one should say that a swallow definitely doesn't make it summer. And I think that's particularly true when one looks at my final chart for this week, which is the WTI Oil future, which, on the news that Mr. Trump was suggesting that there might be some sort of agreement between Russia and Saudi Arabia to cut oil production by between 10 and 15 barrels, rebounded very sharply. But nevertheless, when one looks at that particular chart, from where we've been this year, up at the $60 mark, down to where we are now, and the bounce that we've seen, there's still a long way to go before we A, fill the gap, and B, get into more positive territory. Therefore, bargain hunting, averaging in, I can understand. Nevertheless, we aren't out of the water yet. Those are the thoughts for this week.